Welcome to our podcast. Really thankful that you guys chose to join us today. Today, we're going to be talking about increasing business valuation. Okay, and we have a group of panel members here that are going to be leading the conversation. My name's Monty Clark. I am co-founder of Abound Social with Isaac. We're going to moderate this discussion for you. I'm going to start with Jim Costello. He's going to be your speaker today. He's going to give you a great presentation. Scott Tappan and Raffi Yardemian are part of our expert panel for this. So how this is going to go is about the first 15 minutes, 20 minutes or so. Jim, don't want to put any pressure on you and keep it short, but Jim, who is an expert at this, who has been doing this for many, many years for many different companies, is going to share some great information about how you can increase valuations of your businesses. Okay, and then both Scott and Raffi have extensive backgrounds in sales, leading teams, managing those teams to increase your sales and how to increase business profitability and your valuations as well. So after that 15 minutes, we're going to have an open panel discussion between the two of them, or the three of them, sorry. I'm going to ask them a lot of questions. And if you guys have questions during the presentation, please feel free to drop those in the chat. Once we're past the conversation time, the panel, I will reserve about the last 10, 15 minutes of our call that you guys can unmute and ask questions if you would like as well. So that's how we're going to run the thing today. I'm really happy and pleased that you guys are with us again. Jim, go ahead, take it away.
I want to make sure that you guys are looking at the first
You're
slide.
live. We can see it.
Okay, good. Good. Well, thank you, Monty. Thanks for the opportunity to talk about these subjects. I taught a class in grad school, and I didn't know how long it would take to prepare a lecture. It was an hour-long class, so I spent an hour or two. I got through the thing in 10 minutes. I was embarrassed. So I put a little more effort into this, and hopefully I can make it last as long as 20. But my esteemed colleagues, Scott and Raffi, we work with a lot of small and medium-sized businesses. And when we enter the conversation, it's usually about what they don't know about sales, why their sales may have plateaued and they can't get over it, why they can't find the right salesperson. Are their comp plans working? Most owners think they're overpaying their salespeople, all those kinds of things. But then we will hear in the conversation, and by the way, I'm planning to exit in a couple of years. And that changes our perspective somewhat, because we want them looking at the long term as well as fixing their sales force right now and filling the gaps. And that's what we wanted to talk about today. And my dear friend, David Shavzin, he's an exit planner in Atlanta. He helped me assemble some of this content. Thank you to David. But with that, knowing that when we talk to clients, they all have different perspectives. Some want to sell their business in a year. I've got a client right now that wants to exit in 6 months. And it's like getting a home inspector to come in before you put your house up for sale. If you don't know what's going on with your house, you're not going to get top dollar. And the buyers that come into the house or the buyers that look at the company, they have a different set of criteria than we might imagine. I was a CEO for some time of a $250 million company. I made buku presentations to private equity and then served on a private equity board in the tech sector and evaluated sales infrastructures. And I've seen it from both sides of the desk. And I thought it would be insightful if you're thinking about a valuation for your company and you're not happy with what you received at the first pass, which is 99% of the time. Maybe if you could take a step back and see how the buyers look at your company. Is the company completely dependent on the owner? Can the owner actually sell the company and step away? The quality of revenue, which is where we're going to spend our time today. Is it real? Is it legitimate? I have disqualified more investments than approved because the quality of revenue didn't add up. Are you truly a company with a good brand and a good reputation? Can you deliver that messaging into the marketplace? Have you done any innovations? Are you different in any way from your competition? If we acquire you, what are we going to get for it? What advantages do we get from acquiring you instead of somebody else in the business? Can your business be scaled to fit the buyer's organization and the buyer's processes and what they're looking for? Does your company have the right leadership in all the different seats? Our sister company, EOS, does a great job of identifying the 6 disciplines. Do you have the proper management in every discipline? Are they the right people at the right time? Do you have a sound financial structure? And is the owner really willing to step away? Has he prepared himself? How many times have we seen people try to retire but couldn't because they weren't prepared? It's the same when an owner sells the company. Are they truly willing to go ahead and walk away and move down to the beach and not interfere in the business anymore so we can grow it after we acquire it? The buyers, what looks good to buyers, and again, it's from their perspective, which is mostly a financial perspective, your revenue. Is it monthly recurring revenue? They love that. If it's not recurring, are there long-term contracts? Do you have some signed up for 5 years, 10 years, 2 years? And if you don't have a lot of signed contracts, do you have a documented and valid pipeline? We will talk about that in depth. Again, can you demonstrate loyal customers coming back to you over the years, even if they're not a monthly recurring revenue source? That's critical for reputation, branding, all sorts of different levels. And that's some of the ways that the buyers look at it. When they get into the revenue itself, the sales revenue, they might see red flags if you don't have geographic dispersion. If you want to be a national company, but 80% of your business is in Cincinnati, Ohio, that will be a red flag. Do you have too much revenue from too few clients? We see that almost everywhere we go, where half of a company's revenue is from one client, or maybe 80% is from 2 or 3 clients. If we buy you, can we diversify our client base with what you bring to the table? Do you have a variety of clients across a variety of deliverables that you bring to the table? You have medium-sized clients, small clients, big ones, extra large ones? If so, where are they and what are they buying? And can we build a client base that complements ours if we make the acquisition and bring your clients to the table to diversify our product delivery? All those things, again, they're kind of financial, well, mostly financial from the buyer's perspective. The buyers also have a very simplistic look, and forgive me, buyers, if you're on this call. Whoops. They'll look at a sales organization and very simply, they will say, do you have the right people in the right seats? That's an easy question to ask. Do they have a positive attitude? Are they happy when they come to work? You have to put a gun to their head to make them make sales calls? Are they team players? Do they share? Is it a good, positive environment where people contribute to each other as well as to themselves? Can they play nice with marketing? It's a big thing. Often we end up in clients where there's a virtual war going on between sales and marketing with finger pointing. We want to make sure that doesn't exist. The buyers want to make sure it doesn't exist. And then the buyers also look at comp plans. Are they driving the right behaviors to help you guys hit goals so we can easily adapt them into our system? Are they keeping up with technology? If you're going to sell this company in the next year or two, are your key sales players going to stick around? That's key. Usually we'll have 1 or 2 rainmakers that if they're disenchanted, they might leave. And when they leave, 40, 50% of the business might go with them. So it's important for the buyers to understand the status of the sales team. And is the training and the messaging and all that consistent with where you're trying to go from a sales team perspective? Now that we know what the buyers are looking for from their financial perspective, let's go back to the home inspector analogy. If you're trying to sell your company and you know the quality of revenue is critically important because they're going to buy your company for what it's going to do, not what it's done in the past, then perhaps you should do an in-depth analysis that will enable your company to survive the due diligence process. And we'll talk about that and some of the surprises that can surface. An in-depth analysis that Raffi and Scott and I do and others, we can identify 16 sales drivers. We can find where the gaps are. We can make recommendations to fill the gaps. We can do all those things. And while you're preparing your company for maximum value, you can also increase sales in a sustainable fashion. And maybe you'll decide you want to keep your company rather than sell it. Some of the surprises we can eliminate. And again, this comes from our folks in the private equity business. They're surprised when a company will walk in the door, make a pitch, and then they'll find out that the company can't scale to meet its projections. So you're going to go from 5 to 15 million. How many crews will you need? How many vans will you need? What's the size of the footprint? Can you cover all that? Can you go beyond your geographic footprint? Do you have the right salespeople that have aspirations that can hit those ambitious numbers? Are you building your projections around your current book of business and your pipeline that may not be valid? Is your pipeline filled with happy ears? Do you have a clear line of sight into how sales is affecting your organization, either positively or negatively? And they might learn that your sales infrastructure today just isn't worthy of a long-term investment. It would take too much work to recraft it to make it a good investment. If you do a deep dive evaluation, just like a home inspector, you're going to uncover things that the buyer wouldn't see on the first pass. You're going to gain insights about your own company that you weren't aware of previously. You're going to understand your pipeline, what's valid, what's legitimate, what's arbitrary, what's optimistic. And almost every pipeline we see has a lot of what Alan Greenspan call it, false exuberance, irrational exuberance within the pipeline. Does your pipeline have a realistic percentage of the likelihood of closing new business? You understand all that, you can strengthen your negotiating position. You can actually find new opportunities for growth. But most importantly, you can actually understand where your company is right now and where it needs to be, so you can sell it and get the maximum value. What does a deep dive analysis get you? Most of us, I think we might all agree, learn visually the best. The first easiest way to learn is visually. A deep dive analysis can give you a geographical map to show you exactly where you stand with all of your sales drivers. And again, enable you to fix those, fill the gaps, and plan to the future to have a better, more robust sales engine. It'll enable you to concisely plan for the next 6 months, 12 months, 2 years, and 5 years. And if you're dealing with a private equity company, they want to know whether or not you stick around. They want to know your company is positioned to grow over the next 5 years. They don't flip houses. They buy companies that they want to grow and meld with other companies. It's very important to them that they know you're planning for the long term. And again, it will also help you understand where you are with your 16 sales drivers, exactly where you are, so you can be consciously competent on what you need to do next to get the maximum value. We look at the organization, support, and process and infrastructure. We can start with the organization and your sales structure. The analysis might show your sales structure has a lot of fraternity boys, backslappers, that are following the path of least resistance and may have caused the sales to slow down while still looking successful. And that slowdown may be one of the things that initiated your thoughts regarding selling the company. The sales structure, do you have the right ideal client profiled? Do you have the best salespeople? Do you have the territories covered? Do you have everybody sitting in one territory fighting over clients? Are they going outside a certain geography or a vertical? Regarding sales management, have you punished your top salesperson by promoting them into a sales management position? That very often happens. A top salesperson may not necessarily be a great sales manager. And then the salespeople, do you have the right people in the right seats, as we talked earlier? And with that, Scott?
Sure. Thank you very much, Jim. This is great, by the way. And I'll just say right now that I'm familiar with the 16 drivers, and I've always thought, and you'll see the others, but I've always thought the support area is kind of a conglomeration of all of them. This support, it's going to be very important, especially for the valuation. When you see sales systems, CRMs alone, now I've heard this, I'm not exactly sure where the source is, but I've heard it independently, that if a company that's for sale does not have a CRM, the valuation can drop on average about 20 points. And if you think about it, I'm a buyer in the market. You don't know what the hottest leads are, the deals, contact names, are going to go to the salespeople's phones, pull up Excel spreadsheets. It's very important. I do have a client today that I'm doing just that, setting up all the support needed to make him successful for one day when he's ready to sell. Productivity tools are part of sales systems, but it's also part of sales enablement, and it can be a part of operations. Productivity tools such as the CRM, and you've got a lot of AI capable tools out there that are really helping people, and we are just scratching the surface. Just for instance, Gong is a great way to summarize salespeople's prospect meetings. It's great to show next steps, and just one of many, many examples. And from an operations perspective, if you're big enough and you can have the support to kind of manage all of these, maybe be a CRM support person, somebody who does manage all the productivity tools, it just makes it go that much smoother. And all of this stuff will fit into the sales process and make the company very attractive from a valuation perspective. So that is it. And I'm not exactly sure who's next.
Well, Scott, it's also true too that in every one of these segments, we see the word sales. So it's not just support, it's sales support, meaning the most profitable sales you have are the ones you have with current clients that expand, right? And if you have quality sales support, sales operations where you know where everything is, then it's easier to expand your current footprint within a client, your share of that client's wallet.
Right.
Raffi, are you on here?
I sure am. Thanks, Jim. So I will talk a little bit about the process aspect of sales. And there are 4 components here. And by the way, great presentation, Jim, so far. And this quadrant is talking a lot about the higher level elements of sales. So sales process, and many of us look at this as kind of the 7, 8 stages of sales, from preparation, prospecting, to qualify, discover, negotiate, handle objections, get all the way to closure. But really, what are in each one of these steps of the sales process? What type of questions do you ask a client to move a deal along? How are you staying in control if you're a salesperson and making sure that sales process moves forward? So for a client that's looking at potential exit down the road, it's what is that foolproof, repeatable sales process? Is it documented? Is it repeatable to the point where when some of the sales folks that might be there currently move on after a sale, or the large rainmaker, as Jim alluded to earlier, leaves the organization, do you have a good, structured, repeatable sales process? Which, interestingly enough, in a lot of smaller businesses, is an area that they just overlook and don't implement and have truly documented lockstep. The other components here, I'm actually going through it right now, and it's the time of year where sales budget process really starts up, right? A lot of these organizations, actually at a client that I'm at currently this week, we're going through there's kind of 2 ways you can do the budgeting process, right? Top down or bottom up. And they've taken the approach of top down, which is, hey, we believe for us to get 65 million in revenue this year, we need to book about 160 million. It's a large construction company. And by the time that revenue hits the books, we should get about 60 million of it based on, their recognized revenue model. But this is interesting. I've taken a different approach. They came up with, here's what we believe our clients can generate in revenue. And then I kind of come in right now. It's that time of year where we start with budgeting process and forecasting management, which are both in that same quadrant, and build it from the bottom up. Sit with the individual account managers and salespeople and say, with National Grid, which happens to be a large account, what exactly do we have in potential opportunities? What did we sell them last year? What are the existing opportunities? And what are the plans and a business plan we want to build so that we can forecast accurately from a finance standpoint? So again, this time of year, it's really big on the budget process, forecasting management, and exactly how do you work through making sure that sales and the sales structure is providing a very good definitive forecast to make sure that the budgets are accurate. And then there's another component here. Sorry, go ahead.
No, that's all right.
And then we've got the lead management process here too. This is another area where a lot of companies, we want to try and lock down, what does it look like through the entire sales process? There's 3 or 4 different phases of sales. There's the upfront BDR functionality, where a lot of the lead management component resides. You've got the discovery to close, and then you've got ongoing account management. But the lead management process is another one that really needs to be defined in here. How do you generate marketing qualified leads? How do you find a way to be able to convert those to sales qualified leads? What is that process and who does that? And in a lot of these companies, you've got BDRs and SDR functionality that resides there, and really segmenting that correctly and figuring out, what are you doing in that phase to be able to get these to sales qualified opportunity for your outside rep to be able to get engaged in. So give you a little bit of flavor on these areas as it relates to clients, especially as they're packaging up that diamond in preparation for a potential sale down the road.
Right. Raffi, budgeting for sales from the inside out. Here's where we stand today. here's our sales team today. What more can they get? Can we grow 15%? What will that get? Where will that get the company? Oh, the company wants to triple in size in 5 years. We're going to need more than what we currently have right now in the way it's operating. And clients may have to make an acquisition. They may have to expand their geographic footprint, and maybe it's not possible. Maybe they're going to need 28,000 marketing qualified leads instead of 6,000. Where can they get 28,000? All those things come into consideration. It becomes a complicated process if not looked at the right way. And Raffi, the way you do it is always the best. I had a boss, Kurt Carlson, who said, Jim, I don't care if you look at it inside out or upside down, you're going to get 15% minimum. And we're gonna double in 5 years. And you know what? We did that. Kurt did that for 50 years. It was remarkable. After the process, when we consider that, one of my favorite things to do with the client is to look at their competition and to look at where they are in the marketplace regarding their competition. We can ask clients, what does your client do? What does your competition do extremely well? How is their sales force structured? They almost never know. What's the competition's comp plans? What are they like? They almost never know. Built the company organically, that built it up to 30 million, 50 million, whatever it is, but they haven't looked at the outside to see who they're competing against. The pipeline review, we talked about that. What's legitimate? What's happy years? And what's absurd? Do the usual suspects keep recurring in the pipeline? Can we look at the data for the last 2 years for the company? And then the sales performance must be monitored and managed. And can we actually look, as Scott mentioned, at the CRM and Raffi mentioned at the processes, and understand where we are, what's in the pipeline, the likelihood of closing, and what we need to do to get this company to where it's going. All those components fit together, and you can bring it all together with that deep dive analysis. And a company really needs to understand where it is in each segment. That's what we do. That's how we work together. And that's why when I work with an M&A lawyer like I do named Amit, I hope you're on the webinar, or David, the exit strategist, they look at they don't look at this when they start, but they look at it when they finish. And if we don't bring it to them on the front end, then they discover the surprises, the disappointments, and it colors their opinions of the value of the company. So doing the deep dive analysis, bringing everything together, enables you to maximize the value of your company. And with that, Monty, I will throw it open to you and to the questions that we have in the audience.
You bet. Excellent presentation, Jim. I love that visual there at the end. Really puts a bow on it and brings it all together. And you guys did an excellent job of communicating these different stages. I'd like to ask one question to get it started off. And since it's 1:30 Central Time anyway, I'd like to have you guys see if you could limit your question or your responses to 2 minutes or less. Try and get as much conversation in as we possibly can. First question I have is, in the eliminate surprises slide, Jim, you mentioned aggressive targets, can't scale to hit targets, sales team isn't capable of hitting forecasts. How do you handle those? Could each of you reply to that?
I'll go first, and I just understanding the building blocks of how a pipeline is built so that there are no surprises in it. On the private equity side, I've looked at companies that look very attractive because the margins were excellent on a current book of business that they had, that 80% came from one sales guy. And
wow.
And it was unlikely to repeat, but it looks great right now. Those are the kind of surprises that people will evaluate and look at and raise an eyebrow to. Is it too much sitting within a few people or a few clients? That's usually the biggest surprise that we find.
Excellent. Raffi?
Yeah, in my case, it's some of the surprises that pop up, again, based on the exercise I'm going through right now, is some of the reps, or at least the territory managers, not having a good handle of what the future opportunities are within each relationship. And again, this kind of breeds a little bit into the account management functionality, depending on the type of organization. You may have your salespeople and your account management function being consolidated in a smaller business. And when you go through an exercise like the budgeting process and others, the surprises are, well, I think we might get $1 million, but I'm not sure. Well, what did we sell last year? I think it was 500,000, but we had a broker that helped us get in there. The surprises associated with the budgeting and formally identifying what your future revenues will be on relationships is one of the areas you really need to eliminate. And I think having a better grasp on exactly what those relationships look like and what the future potential is. I think Jim did a really nice job talking about this and what's realistic. Somebody could come in from a leadership standpoint and say, we're going to double revenues with that particular account. Well, how? Is there a plan? Is there a strategy? And those are the areas, again, this time of year, doing territory plans, salesperson reviews, and building it up with, come in here and give me your business plan. You own your own business within the organization. Tell us what these 10 or 15 or 30 national accounts that you've got are going to potentially create, and what are the roadblocks we can help you eliminate. That gets you more definitive and eliminates the surprises in that area.
Great input. Scott, do you have anything that you wanted to add to that?
Yeah, I would. I see, I've experienced this, whether I was working within a company or just in my capacity now, but when you have unrealistic goals, and you do see that a lot for owners that are putting their place up for sale, they think the place is worth a lot more than it is. And when the realistic factor comes in, they're surprised. But what ends up happening is if you have some of these unrealistic goals, you're going to start seeing turnover. How does that affect the salespeople? In a normal day-to-day operations, you want to make sure, especially if you got a new comp plan, you want to make sure the comp plan is aggressive yet attainable, that it's a win-win on both sides. And granted, the owner's trying to really make his place look as profitable as possible, but that starts to trickle down to everybody. And realistically, owners should, especially on a new plan, should look at it quarterly at first, and then just make sure that no one party is getting taken advantage of. And then as the time goes on, it starts to be consistent. The salesperson has an opportunity to make money. The business is making money probably off of one of the measures of margin. Then maybe you look at it once a year. But yeah, you just have to have realistic goals, aggressive yet attainable.
Fantastic. Dale, I'd love to bring you into this conversation too, as one of our guest panelists. Can you tell me, how often should you change compensation plans for your team?
It's an interesting question because in my experience, compensation is the most emotive topic. It's the quickest way to distract. It's the quickest way to derail focus if you're not careful. So if you're constantly making changes, you're not going to get the team narrowed in on the things that they need to accomplish, because they're going to spend a lot of time understanding how can they make money. And I've found it just to be a huge distraction. So, we typically historically have done it once a year. Certainly we will throw out spiffs and other things to create, and competitions to create some fun. But, the more you do it, the more confusion it creates. And I think an organization that is moving on all cylinders is one that is pretty, we want aggressive, but you have a strong foundation without a lot of change. People cling to stability. So I think if you do it too often, you start to disrupt and create just too much distraction that I think is unnecessary if you want a team to be highly efficient.
Dale,
Right.
if I can tag on to that, Monty.
Yes.
We have clients that will go into, an underground mining equipment manufacturer, an engineering firm in the Southeast, a fire protection company, where we will get sales ramped up and a good comp plan in place. And as soon as the sales start to happen, the operations folks say, hey, we're at full capacity in these 3 areas. Don't sell anymore. Sell this one. So how do you keep the comp plan robust and flexible enough so that the salespeople can be focused on what you need them to be focused on?
And maybe I could take a stab at that. I'll piggyback on, I know we went into the compensation plan, but this is one of those areas where, again, this time of year where we're all getting ready to help build out plans for next year. I think another really good exercise is, at least my philosophy is, you take 3 components in and you build up a really good comp plan. You take the best interest of the company who's making was creating that compensation plan. What's the drivers you want? What are the margins you're looking for? What are the products and areas that you want them to drive? Then you take the best interest of the client, right? You want to make sure there isn't a comp plan that deviates and puts them at risk and has the salesperson selling them stuff they don't need, or products and services that aren't relevant to them. Then you take into consideration the salesperson and the individual associated with this and what's in their best interest and their compensation. When you blend all three together and you build it into a comp plan, you should hopefully be having a plan that all you really do is make adjustments on an annual basis, knowing that these are the drivers. The business may change next year and you may want higher margin solutions or complementary products or longer term agreements, anything like that. You build a plan to drive that, then you can hold salespeople and the team accountable to what the plan says. And you don't have a conflicting element where you're sitting in sales meetings telling them to drive this activity, but their bonus structure says something different. Salespeople are going to drive whatever's going to make the most amount of money for them. That's what you hired them for. They're driven by that. Build the plan correctly. And again, start with the company, in the interest of the client, and then the salesperson, and you've got a recipe that works really well.
Excellent. Excellent. Scott, do you have anything you want to share, or do you want me to go to the next question? Let me mute it.
Sorry about that. I was pretty interested in Dale's response when he was talking about, always changing the plan. One of my clients a little while ago, the salespeople were saying they're always moving the goalposts on us. And that's true. I mean, if you can, and to Dale's point also, it just makes it confusing. You really don't know what the true metrics are. And to Raffi's point, yeah, they're going to go after this, but then tomorrow they're going after this. A lot of confusion. Don't move the goalposts.
Excellent. Jim, I'm going to start with you on this. What's the biggest sales related challenges that you face when you're trying to maximize the growth of a company? Can you just share maybe a short story that you have, or what's your input in on this? And I'll round robin this with you guys too.
Absolutely. I don't know if you call it a challenge or an opportunity, but I have a client with 4 different divisions, and each customer that they have can buy from all 4, but they're all standalone divisions in their delivery. But they don't have anybody that cross-sells. And the division leadership isn't interested in cross-selling. They're interested in their own silo. And to hire a good salesperson and put them into that environment can be a challenge unless the owner CEO understands that they need to model their culture so that everybody is pulling together and that everybody wins. And then building a comp plan around that. That's the case I just mentioned with where salespeople have come in and sold lights out and filled 1 or 2 divisions up way over capacity. And now the company can't scale to meet it while the other divisions languish. So it's having the right salespeople, but then the right operations and the right deliverables behind it so you can maximize a client opportunity. And I think we all know intuitively, but we can certainly know it mathematically. Our most profitable business comes from current clients growing our sphere, adding more services, spending more, being around longer. The cost of servicing them go down. The cost of sales goes down. Everything gets better if we grow our current base of business and then add ideal clients like those. But when you try to do it across different divisions with different objectives, it's very difficult. So the owner CEO really has to understand how things fit together to enable salespeople to be at their best.
Excellent. Dale, would you mind sharing your insights into that?
Yeah, I mean, it's interesting example, Jim, because when I went to GE years, we had 9 different divisions, if you would, selling to the same customer. So you can conceivably see 9 different people. So we primarily solved it by creating an account management structure that worked across all of those different divisions, and they acted as the quarterback to bring the different teams, the different technical teams together to grow and build the business. So it's an interesting example, and would concur. It's in the end, for me, the structure in of itself isn't what helps you accelerate growth, but the structure is an enabler to do it well. So if you and then I love the framework that you presented, because if all of the different pieces don't work, it's hard to accomplish your goals, right? If you don't have the right people on the bus, if you're not driving the right incentives, where they're focused on the right things, with the right structure, with the right training, so they're enabled with the technology, the tools, the training, and everything that they need. It really is, the bolus or the body of all of those things that drives, I think, success. And most companies miss a lot of those elements and wonder why they're not growing.
Excellent. Raffi. How about you?
A lot of the information's kind of been said. I don't think I have an additional context on that. I think really well.
Hey,
Why don't I move on then? Go ahead, Jim.
Dale, do you ever use non-financial incentives with salespeople?
We do. I mean, done it in different places, trips and things like that. Or, we've always thought about fun things like, should you, give them a nicer car for a period of time, where at the sales meeting, they recognize, they're driving a better vehicle around. I guess that would be considered a financial incentive to some extent, but just perks. Give them, one of the things we often do is we give them more airtime amongst their peers at town halls and places like that. Because, one of the things that we've learned is they don't listen to us as much as they listen to each other. So the more we can do to get those that are excelling and then use them as sort of the model behavior that the others can follow. So, and that in many ways is a reward, because then they're now recognized by their peers as well as an expert, so you don't always have to throw money at it, but there are some fun ways to create that visibility and sort of create some respect within your organization.
Dale, GE is famous for its culture. IBM, the strongest culture within the quick service restaurant business. The founder and CEO asked me once, put me on the spot with his executives, explain to me why I should be doing these trips and award banquets and recognition. And I made it up, but it was the right answer. I said, well, Mr. Kathy, is money the only reason these people work here? And his culture was so strong, he was offended by the suggestion that they would only be there for money. And then he said, okay, do it. Now get out of here. But that's
awesome.
right. So it's got to be a cultural thing too, where non-cash incentives can work. But if they do work, you can reduce a lot of bonus expense by helping people feel like they're part of something bigger.
Yeah, I agree.
Fantastic. Since our time is growing short, I want to make sure I get some questions in here from our audience. And Steve's asked some fantastic questions. So I'm just going to go ahead and read those on behalf of you, Steve, if you don't mind. His first question was, what do you do, or how do you approach a buyer in his 70s that's not found a successor that thinks he's going to turn everything over the day before he goes toes up? Raffi, let's start with you.
That's an interesting question. I was reading your second question too, Steve, but somebody in their 70s, you know what? Part of it is you need to bring in some systems and some methodology that is in line with the person that's going to be purchasing. To make it sellable, you also got to make sure that you're investing in tools. Even something as simplistic as maybe an EOS methodology across the organization that may look at process, structure, accountability across the organization, where the system will kind of drive the activity. Bring in some technologies. You asked a question specific on CRMs, which I'll probably weave in here too, Steve. I had a little answer set up there. Where is there a CRM that buyers prefer? They don't prefer a specific CRM because you don't know what the purchasing company or the acquisition company is going to have. So integration, all those are not important. But I think what they do really value is a CRM, and one that's being utilized correctly, crap in, crap out. So making sure that there's some structure around making sure that if the sales team does get turned over, or if the leader's not there anymore, do you have enough in your CRM? And is there a repository that makes sure that you can run the business and continue those relationships without being dependent on Joe Smith that's no longer there? So I think that answer, which kind of tailors into your first one, which was a person in their 70s that has a business, make sure you've got a good, robust CRM that's being utilized correctly, and that the analytics are there. You can run the business off of the KPIs and the metrics that are built into that CRM, but have a CRM, make sure you look at some technologies and some other elements that can be attractive to the new buyer. And the big buzzword right now, and I think one of the previous meetings we all had was on AI. Overused term, probably, just like, cloud services was a while ago, et cetera. But having some level of AI technology and some of the tools that may make things a little bit easier and streamlined, I think would be very beneficial to someone that's probably a little bit further in their career, looking at getting this to hopefully an individual that's purchasing the business that's looking at growing it at a younger age group, I guess.
And Steve, I'm going to have you on mute, and actually, maybe we might need a little bit more context on your last question. You said is a 1 to 2 year time frame typical for sellers, or are most further out? Are you talking about the process to sell, or explain that maybe? And then Scott, I'd like to have you follow up with this.
Yeah, I helped two gentlemen sell their company, and it was just quite an experience to be involved with them. They they were mature enough that they were far enough along emotionally to be ready to sell, even though they had unreasonable expectations. And so I stepped in at a point when they were ready to say, okay, let's do the process. But I also work with companies that are earlier stage, and I work on tax mitigation. So I'm looking to put money to the bottom line via reducing expenses or increasing tax credits. And it seems like they need to be in a 2 to 5 year time frame before they're ready to get the company teed up to sell. So, I mean, I may have answered my own question. You're going to see the whole spectrum, but really, from and I'm a long-term sales guy. You can't implement a sales fix today and expect to sell it in 6 months. That's got to happen a long time before that for that all to roll in together. So I don't know how you all respond to that.
Scott, why don't you start?
I'll just make one comment about it. First, about your question about the 70-year-old. Well, there's a good chance if he's doing it before his toes up, good chance that business is not going to get anything. Now, certified exit planners, which a lot of people at Sales Acceleration work with, those are called CEPAs. Their ideal time is 5 years out because there is an awful lot that needs to take place. The reality is it's not going to happen. Probably on average, it's a couple years, but that would give you enough time to get, from our perspective, just the sales infrastructure in place, the processes, build out the CRM, have a good drip campaign, communication cadences. That will probably be the way to go. However, you got all the other departments, finance, what's HR look like? You got a good, robust HR. Every department is going to be very important to it. But I would say a minimum of 2 years if you really want to start to see valuation be there.
Right. Isaac, you had a question. I'd like you to go ahead and ask that, and we'll have the panel respond.
Sure. So a couple of years ago, we were working with an organization that was trying very intentionally to go public. And we were working with their sales team, and one of their main sales individuals, they left. And the sales manager jumped into Salesforce and pulled up the pipeline. And he was going, all right, our evaluation is going to be correlated to what's in the pipeline here. So he starts calling the people that was in this salesperson's pipeline, only to find that, like Raffi had said, garbage in, garbage out. And everybody in her pipeline was not actually an opportunity. And there was a little bit of frustration there, as you can't imagine. So I would love to hear if you have any simple advice for any business looking at their evaluation to prevent that scenario from happening.
Jim, why don't we start with you?
Yeah, one
Sure.
of the ways to do it, Isaac, is to understand the sales cycle and look at past pipelines. If the sales cycle is 3 to 6 months, and you can see that a prospect has been in the funnel for 2 years, it's just not going to happen. And dumping old data that didn't work out is key so people can understand where they actually are. But understanding that sales cycle and the competition, in the software business that I used to be in, it was determined after great analysis that you couldn't close a complex sale before the third sales call minimum. Usually it was 5, the best sale. If you go past 9, it's not going to happen. So look at the pipeline, the age of the prospects in it, how long have they been in it, what they're buying. Well, you might find out that the salespeople have made best friends out of a prospective buyer, which can hinder them in the entire company because nobody wants to say no, so they don't qualify hard. So that's one of the things that can be easily seen in a pipeline if you look at past data and then what's coming down right now, what could be closed.
I'll also take that on just quickly. Every sales meeting I have, I make sure that we talk about the pipeline. What kind of support do you need? Are you hitting any brick walls? And and it's just being familiar with what's out there and keep discussing it. And then maybe at a high level with the owner, just kind of getting top level, but the sales manager should be right on top of that. And garbage in, garbage out. It doesn't exist. Or if it's not in the CRM, it doesn't exist. All those cliches, but you just need to be familiar with the pipeline and just that's your lifeblood. And if you start having issues there, you're probably going to have issues elsewhere because you're not paying attention.
Excellent. Here's another one for you guys. In your experience, what does sales excellence look like on a day-to-day basis? How do you measure it and enable it? Dale, you want to take a stab?
Sure. I think it means a lot of things, right? It's about, as a company and an organization trying to be better every day, right? Because even our best sales reps haven't arrived. We all have an opportunity to get better. So when I think about sales excellence, it's do we have the right, it's a lot about the framework that you showed, right? It's about having the right people. It's about, when you think about sales enablement, it's about ensuring that they're well prepared with the right tools, with the right training, with the right motivations, the right incentives, and those sorts of things. So I think you have to take a look at it sort of holistically, and then, constantly pressure test. Are we, where are we weak? Where are we strong? Where do we need to get better? But it's kind of around that notion of just continuous improvement. How do we just, how do we keep getting better at handling objections? How do we get better at prospecting and finding customers and those sorts of things? So then the question is, if you think of it holistically, what are some of the sort of the important KPIs that you look at to make sure that we're in fact driving the right behaviors and the right things? And we usually, without giving necessarily a bunch of specifics, look at leading and lagging indicators, right? So, the leading indicators could be things like, what's the top of the funnel look like in each of the respective territories? What's the quality of the sales conversations and the opportunities, all the way down to the lagging indicators, are certain territories achieving the results that we expect, or whatever it may be? Is it profitability? Is it revenue? Is it whatever it may be? But we've got to, we've had, just like my business, we have a sales KPI scorecard that sort of measures all of the different things, and those in aggregate, I think, is what drives excellence within our organization.
Fantastic. Raffi, what's sales excellence look like?
Yeah, great points, by the way, Dale, and very much in line with my thinking as well. But I think of really having a good plan. As a salesperson, really having a clear, concise plan. And part of it is, as salespeople, what do? We ask questions for a living. Make sure you're asking really good, pointed questions, identify pain points, and then match up your product or your solutions feature and functionality specific to those pain points. And again, I think it's the excellence for me is having a salesperson that comes in that knows they've got a plan. They know exactly what they're trying to accomplish from this discovery meeting or this qualification meeting, and not convoluting it. I mean, all of us have probably been around salespeople in a room or trained them where they come in and tell you all of the feature and functionality of this vehicle that you're about to show interest in. But the value you're looking for is a reliable vehicle to get your 19-year-old back and forth to college. The mud flaps and the floor mats and all those don't really necessarily mean very much to you. But this person is so clear, concise, that they are going to come in and tell you all the feature and functionality of the vehicle. They don't have a plan, and then potentially talking you out of a sale because the pain point you're trying to solve, they're not, the salesperson's not identifying exactly what that pain point is and how their solution is going to take care of it. So for me, it's both the plan that the rep has, but then from a sales management standpoint, having a good concrete territory plan as well. How many people do you need? What's that repeatable process? And eventually getting to the point where you're not reliant on an individual, or the business is not held to one person that they're so reliant on. The process and the structure in the organization has a plan and a process that, in some cases, as you promote people into management, you bring in new salespeople, you still have that engine and that plan that can continue growing the organization. That's when you, I think, achieve excellence in sales, when you're not reliant on just individuals and more of the system and the repeatability of it as well.
Can I jump in here, Monty?
Absolutely.
Raffi, I think you hit it on the head with sales execution. And Dale, the way you look at it explains your success. I think sales excellence starts with the CEO. Does he take the salespeople on a death march every week through a pipeline? Or does he enable a sales leader to have a playbook and a guide to say, this is exactly the right way to manage sales for this organization? And then does the sales leader turn around to the salespeople and say, here's the sales playbook. Here's the sales process to execute. Here's your target market. Here's your ideal client. Here's the training you need. And then when the CEO interacts with the salespeople, which is, unavoidable and sometimes a blessing, do they say, hey, how's it going? How can I help you be more successful? What do you need from me? If the CEO has that culture, that mindset, it enables every step of the organization to be excellent. But bottom line, Raffi, And whoever asked a question about CRMs, I have to explain to CEOs all the time, wait a minute, your CRM is not for issuing tickets for vans to go deliver stuff. It's for a salesperson to come in the morning, open up their computer and see, here are the 20 calls I need to make today to these people. Here are the 5 tactics I need to take with these people to move them forward in the pipeline. Here's exactly what I need to do. And I know my time is perishable, so I better get after it. And everybody wins. So that's where the rubber hits the road. But beyond that, I think it's CEO has to drive that leadership and that culture.
These are all such great insights. I appreciate it. Have maybe one more, 2 more, if we can squeak it in, questions. Scott, I'd like to start with you on this. And
Okay.
with all the structure that we've talked about, it's been fantastic. How do you balance that structure with allowing flexibility and innovation in sales?
Well, there's,
And where do you see any risks involved with that?
yeah, there is so much that goes into this, and you're going to need a lot of flexibility. You don't want to spend using any one element of that whole deep dive and spend a lot of time on that and forget about others. Then it does go beyond this too, to the operations piece that Jim was talking about. Do they have enough resources to support the sales that are coming in? That's going to be important too. But just make sure that not everything is rigid. I always look at these systems as a living, breathing system because there's best practices. You'll find a salesperson has a great shortcut. Well, you don't want to have them go through the regimented process that you've always had. You got to be flexible, alter it, and let everybody kind of flow into that best practice. So I think flexibility is very important.
Yeah, and I think
Fantastic.
Jim's talked a little bit about culture, and for me, that flexibility starts with the culture and allowing innovation to take place. Right? We don't want a bunch of robots. We want a lot of really smart thinking people that want to try a lot of things, and we really work hard culturally. In fact, we feel like culture is one of our biggest differentiators as a company, and we want the teams to have the latitude to try things that may work for others as well, ultimately. So I think it starts with permission to try, experiment, and explore new and better ways of doing things, because we know life moves fast and things become obsolete fast. So we should always be pushing ourselves to embrace the new and the new ideas.
Excellent. I appreciate that very much. We're right at time, but I have one more question that I want to ask you guys, because I think people that will be viewing this will actually want to hear it. So I'd like to round robin this question. When have you needed to overhaul sales with a company? Can you quickly walk through that? And what were the key indicators that drove that kind of level of transformation that you had to be involved in? Raffi, why don't we start with you?
Got a couple of them. One I'm going through, interestingly enough, right now, where majority of the change will really be based on, Dale mentioned it earlier, some of it's culture within the sales team, driving the right activity. But once we go in, and I think both Jim, Scott, and I, as we go into some of these organizations, we help them with structure process. Again, back from an EOS standpoint, building all of that into the sales organization. Once you build structure, accountability, KPIs, very quickly you'll look at it and say, this person might have been here for a few years already, but it's easy to get lost in the shuffle in the sales organization sometimes if there isn't that accountability and the CRM isn't being utilized to the level it should. So once we go in, probably 60 days into it, 30 to 60 days into it, first 30 days, you get a chance to identify what the current environment is. After that, once you start putting in some process and structure, you say, all right, you know what, if you're not meeting the expectations associated with appointments and people you got to meet with, or activity associated with the early indicators, within a few weeks, you should be able to look at it and say, this individual or this department or some of the folks in here are just not your long-term growth. Because some of the things we do today are going to turn into revenue 90 days from now. There are some elements that as long as you're doing all the basics, a lot of it does become a numbers game, which is exactly what activity you're doing to look for future revenue. And, that's the only time that I really get involved in. I don't necessarily say that it's the engagements that I enjoy the most. So when somebody says, come in here and overhaul my whole sales team, I say, well, that's what your perception is. I'm not necessarily sure that's what you need. Let me go in there and see if I can help you figure out if that's what's needed, or potentially you just don't have the structure in place to allow these people to be successful. So sometimes it looks like an overhaul, and it really is some of the salespeople that are lost in the shuffle saying, I just need a little bit better direction and structure. And that's, in a small and medium-sized company, it's tough because we don't have the resources to hire a CRO, sales manager, sales enablement. And you kind of build that in as you hopefully either hire one of us or bring in a sales manager that builds that accountability and structure.
Love that. Jim, how about you?
Well, a real world example was a client that had been at 20 million in sales, plus or minus a few $100,000. 2 top salespeople retired. I walked in the door and they were at 6 million. And they had 4 salespeople. And those 4 salespeople have been there 5 years. And you do the math and it's easy to see they didn't have the right people in the right seats. But spending time and understanding their market and their sales process enabled me to ask these salespeople the questions. Are you sure you want to be a salesperson? Because as Raffi just alluded to, there's and Dale, KPIs are going to come into play. You're going to be measured. And if you're in sales because you want to earn a great living, why are you satisfied with where you are now? If you're not dissatisfied, you probably shouldn't be in sales. And why are you in the office every day when the business happens in front of the customer? You can see disconnects right away visually, and you can see it emotionally when you ask just a few hard questions. Then Raffi and Dale and the others have touched on, Scott, when you start to build the KPIs and you put them into a measurable process, whether it's a CRM or whatever it might be, then it's easy to determine, you know what, we have 4 guys in here that want us to hire 2 others that are their buddies. Maybe they're going to play cards when we're all gone. Maybe we don't need those 4. Maybe we need 2 of the 4 and we need 2 more in Birmingham and 2 in Nashville because we need people in front of customers. Those things evolve once we do the discovery process and really understand what's missing. And it's most often what's missing is that the owner, CEO who built the company did it kind of shoot from the hip organically. They hired people late. They may be stuck with a relative that needed a job. And then we will come in and we have to make everybody understand there's a comp plan in place that we must follow. And it will pay you handsomely if you work hard. And if you don't, we're going to go help you find a place where you can be happier. It might be within the company and it might be without the company, but we're going to find you the right seat to get into. And Dale, by the way, talk about change and all those things that we're talking about right now. Do you find that your best salespeople are the ones with the confidence that they can walk into a client and disrupt? They can tell the client, no, you're looking at this the wrong way. And
Yes. Yeah. I mean, I think the best sales reps are those that challenge the customer in a respectful way, 100%. And, we work in the life science space. So we, PhDs and really smart people. And a lot of times they're afraid to have those tough conversations with customers, but in my experience, those that are willing to disrupt are the ones that are the most successful.
Excellent. Okay. Well, I know we're short on time. Raffi, if you want to answer that question, we got you on that one, right? I think so.
You got me. If I could just, before Scott jumps in, one last thing. I think Jim and I worked on.
Well, I think Scott needs to jump. So before you answer that, Scott, did you want to add any last remarks before you go?
No, just I was going to say all my fellow advisors kind of had their own approach, over time. You just see what works and what doesn't. I usually start off by developing the KPIs, and that turns into one-on-one interviews with the salespeople, let me know how they operate, and then the compensation plans. And after that, I start the structure and doing whatever we can do to just support those KPIs and give them the tools to do it. So that is it. Clear. All right.
Thank you, Scott. Really enjoyed your input here today. Thank you for joining us. Raffi, I'll let you close it out.
Yeah, actually, Jim and I worked on a client together. And I think one of the things that's really an interesting element is when you come into an organization and there are folks that have been slowly but surely migrated into a sales role because they look over and they see all these people that are having so much fun golfing all day, and sales is such a lucrative place to be. And in every iteration, there's somebody that got lost in sales, or you come in and somebody asks me to interview someone that they think would be great to go into a sales role. Part of our role is to try and make sure that we let somebody know all of the things you're seeing on the surface. That's not what sales is. Yes, there's a lot of freedom and opportunity, but I have to tell you, it's probably one of the most difficult roles there is in a company, because at the end of the day, it's visibility, it's black and white. You've got you may have your role's at risk on a 30-day basis. We live in a 30-day bubble. So yeah, there's a lot of flexibility, but in many organizations, I think that's the unfortunate thing. They don't value the role of sales, and in some cases try and find a home for somebody, move them into that role. And those are the areas that we look back and say, I'm doing you a disservice for being in this role. The company's doing you a disservice, and this is why it's not a fix. So those are the only places I really see a lot of mismatches and areas that we need to undo. It's a great place to be. Love sales, but it's not for everybody. So
No doubt about it. No doubt about it. Well, it's been a fantastic conversation. Jim, fantastic presentation. Dale, thank you very much for joining us and being a part of our panel today. Next month, we're going to have another excellent conversation. So everybody feel free to come back and join us. We want these to be learning events, and I think today that delivered. So thank you all, and we'll look forward to seeing you all next time.